Good evening, I'm Ross from Smith 150 Group Property Accountants, and we're just going to look at a simple example of a rental available at the moment. So this is one I haven't actually looked at myself. It was one just on a forum. It just had some basic information, so I don't have all the details, but just have, basic look, a quick 5 or 2 minutes looking at what the cash flow looks like. Obviously with a property, cash flow is one part of it. So you need to also look, what's your added value? What can you do for the property? What's your future with this property? What's going to happen over the next 10, 15, 20 years? But obviously a big part of it is cash flow. So this was a Norton example, which is an average area in Hamilton. It's definitely not your best area. The person was asking, what happens if I buy a property? The CV is 800,000, so we'll start with that. And yeah, my first things is going to be some costs to buy it. You're going to get a valuation. Maybe there's going to be some legal fees. There's going to be some other bits and pieces. Maybe you'll set up a company. So think about those other costs. There is other costs to it. You'll get some sort of contribution normally back from your bank. And I always look with 100% debt. Say you've got a couple of 100,000 cash. Great. You want a return on that cash. You don't want to get zero return. So the best way of showing that is just to do your calculations on 100% debt and see what this looks like. So we're buying for 800,000. We're borrowing 800,000. Hopefully I said that right. Buying for 800, borrowing 800,000, full 100% debt. Then we're looking at what's reasonable number of weeks that this property is going to get rented for. The rental appraisal is 800 a week, so that's quite high for Norton. Either it's a really good house in Norton or it's got 2 properties on there. So what I do is think about what is a reasonable number of weeks. Let's be nice and we'll go 51 weeks for this property. So yeah, it depends on the property, you'd need to look at it. So yeah, rent 51 times 800, 40,800 divided by 100,000 is a 5.1% return. So some people saying, that's great, it's a 5% gross yield. Let's look further at the numbers. So then we've got some accounting fees. Unlikely to be a body corporate, but yeah, if there's an owners association, you've got shared costs. Make sure you factor those in and make sure they're reasonable. Let's presume it's one house, so we're probably looking about 1,800 of insurance in Hamilton. If you're Wellington or Christchurch, you're likely to be higher than that. Yes, just be careful with insurance. Make sure you can get insurance as well, especially if you're social housing or something like that. Moment 1 year fixed rate 4.99%. So we've got 40,000 interest, and these numbers are interest only, no principal on here to start with. There'll be some property manager. You'll get a property manager in. So I've done this on about 8% plus some GST plus maybe a fee to find a tenant. Rates, yeah, something like 2,800 would be a good guess without knowing the Norton property in depth. And then repairs. So most likely it's an older property. Presuming it's on a reasonable section, got some trees, needs painting long term. Yeah, it all depends exactly what it is. So you could easily be 3,500 of repairs. You might be more than that. Depends on the property and how much work is needed for it. I then allow for some education. You might join your local property investors like Waikato Property Investors. This person was out of town, so some sort of travel. So I've got 55,000 of expenses. So straight away, cash flow, we're looking at 40,000 in, 54, 55 out. We're losing 14,000 cash. We would then get some chattels. Don't know exactly how new it is, but let's say we've got some reasonable carpet, curtains, dishwasher, stove, heat pump. We would value it in. They'd do a chattels valuation. We would get some depreciation that reduces our tax. So under the old rules, huge tax loss of about 18,000, no tax to pay. Awesome. But we're buying this property now, so that if this is an existing property, it's not a new build, you're not leasing it social housing, you have it converted it one house into 2, have it subdivided it, moved that front house or something, it'll be existing. So we won't be allowed to claim the interest deductions because we're past the dates. So no 39,000 deduction, we will have 0. So our cash profit or our taxable profit goes from minus 18,000 up to 21,000. Our tax at 33%, presuming this person's a reasonable income earner, goes from 0 to 7,000. So we're losing 14,000 plus paying 7 in tax. We're up to 21,000 loss, and that's at the current interest rate of 4.99. Obviously, that interest rate goes up, this could go up as well. That's all on interest only. So I do a bit of a summary. If it was a new build, you'd be losing 14, 15,000. So that's still pretty scary numbers, but it's not a new build. If it's existing, you'd be losing 21,000. It's not existing. You're buying it now when there's no interest deduction. So we're up to 23,861 expected average loss per year. That's me sort of guessing that your costs are going to go up with high inflation to start with. Your rent's going to go up a bit. And yeah, interest rates perhaps go up a bit, then level out. That's interest only. If you went P&I with 34,000 that you'd have to put in per year, those figures are hideous. So to me, you'd be looking at this property. If it's got some really big added value option, you can subdivide it, stick 5 houses on the back. That might be interesting. But if this is a house, you can't subdivide it. You can't do something else that's really clever, turn it from 1 into 2, one house into 2. You can't add a bedroom or something. I'd be looking at why on earth would you want to lose 20+ thousand a year? If we look at it another way, what would we have to do to that value to get it reasonable? So let's say it's 800,000, but you could get it for 700,000. So 100,000 discount, we're still looking at losing 16,000. Average long-term interest rates going up, losing 18,000. Ooh, still a huge loss. Let's go 200 discount, 600,000. Yeah, still looking at $12,000 loss. Let's go 300,000 discount, down to 500,000. We are looking at about 7,000. It's starting to get a bit more manageable, but that's still obviously $150 a week on interest only. So realistically, you'd want the property ideally to be a little bit cheaper. You'd want it to be 450,000, maybe to get down to sort of 100 a week that you have to put in at the moment on interest only. Maybe that's manageable. So you're sort of looking, if you're talking about a gross yield, you're looking at sort of a 9% plus before I'd even start looking. And even at that, I wouldn't be buying at that. I'd want some sort of added value option. I wouldn't just be buying a stock standard property at that and just hoping it's going to go up. I would much rather buy something where I could add some value, do something for it. So many great tricks out there. Yeah, minor dwelling on the back, duplex on the back, subdivide it, one house into 2, add a bedroom, so many different options with it. But yeah, it sort of shows you how much you have to discount. You have to go from 800,000, you have to buy for sort of 450 to make that yield reasonable and get the cash flow reasonable after you're losing interest deductions. Let's say that yeah, the government changes and those tax deductions disappear. So at that level, it would be making 30 or 3,000, well, over 10 years, 34,000. So it's only making 3,000 a year interest only after paying tax. If it was a new build, or if, for example, ACT got in and changed the rules, lots of big ifs there. I'm definitely not saying that's going to happen. So yeah, even if you can get the interest deductions, you're still sort of wanting something like that. Maybe you could afford 550. So you're still looking 800 down to 550 to get it. So you're making a small loss, $1,000 a year. But that shows you, even if it was a new build, you'd still have to get a huge discount. So overall, buying this property, 800,000, existing property, to lose 23,000 per year, interest only, I'd just be wondering why. Why would you buy this? And you need to have a really good, other option up there, some other really good added value to make that worthwhile. So hopefully you enjoyed that. Have a look on our Linktree link, which I'll put up in a few minutes. We've got, I think 4 more webinars coming up shortly and some more to add. Rental Basics on tomorrow night. So really good if you're just wanting some basic knowledge about that, some basic numbers like that, looking at a new build, looking at existing, looking at maybe something that can actually work for you, plus a bit of other information. We don't sell properties, so that's one of the best things. We give advice, we give education like this. I don't sell any properties, so I've got nothing to sell you, so I'm unbiased. Be really careful that a lot of people or a lot of organizations that are supposedly educating you are trying to sell you something. So just be really careful of what that is. So hopefully you enjoyed it. Yeah, have a look on our Linktree link. Lots of great webinars, lots of good videos to watch on there. And yeah, you also free chat link if you want to have a catch up with our property team. So hopefully you enjoyed that and hopefully you've got something out of it. Thanks a lot.